What is going on, fellow investors? I thought I'd talk about a new position which I've just opened as a short-term swing trade. And this is a stock that I've been following for a little while, but I think it's got to a point where the valuation looks really compelling. I think the stock has been oversold. There's definitely been an overreaction from both retail and Wall Street when it comes to selling off this stock. And like a lot of smart money does, we go out and we look for opportunities where we can find relatively good businesses with good fundamentals, good financials, good moats and good thesis at a good valuation. And this is where I think we see a little bit of an asymmetrical linear lineup with a stock that I think is a little bit beaten down. And this stock is Applovin. Now, I entered this stock a few days ago and I've done a little swing trade just after their earnings. I made about £50. I got the stock at around 3.30, exited at around 3.45, took my money and then left it to bed. And then recently I've been looking at the share price and it seems to keep going down. Now, the earnings weren't great, but they weren't too bad. I mean, we saw EBITDA revenue of 87%, EBITDA margins of 82%. We saw year-on-year growth of 56%. We saw management yet again announcing more and more share buybacks, 550 million last quarter, $1 billion this quarter, $2.56 billion worth of shares. I believe that's about 23.6 million shares last year was bought back by management. Around 4 billion worth of share buybacks or committed buybacks in which they will be doing. And the numbers look relatively good. Revenue grew by over 70% and it's got to the point that the valuation looks really compelling. I mean, we've got a forward to earnings of just 15.5. The cheapest it's been since June 2025, which is when we had the Trump liberations tariff sell-off where the whole market went for a bloodbath in June of last year, and then prior to that it would have been around May 2024. So from a forward to earnings you are getting relatively good valuation at just 15, and from a price to earnings you're sitting at around 23.5. So you're not getting it super cheap, but you're definitely getting it probably lower towards the intrinsic value model. And speaking of intrinsic value, I did do a discounted cash flow and I did try to imply around a 12 to 15% of margin of safety, though I appreciate most people when doing DCFs try to imply a 10% margin of safety, so you could say I've been maybe a little bit more ultra conservative, and I came to a fair intrinsic valuation of just north of $400, and that's with a 15% margin of safety, not a 10% margin of safety. So one could imply that maybe the intrinsic value of this stock could be as much as $450. So it's got to a point where I'm looking at the stock. It's a well-respected business. I like their moat, I like their financials, I like the fundamentals, I like the thesis of the business, I do like their management team, and like I've been saying, they've been doing a lot of share buybacks, which is quite good because when businesses are buying back their own shares and retaining some of that float to themselves, it's telling me that management, their CFO, their accountant team are obviously thinking that the stock is too cheap, just like we've seen a little bit with HIMS now and again, and we've seen with Grab more recently. When these businesses start announcing share buybacks, it's a good bullish indicator to investors that, hang on a minute, management themselves think this stock is cheap and now they're buying their own shares back. That is quite interesting, and that's something I definitely think a lot of investors need to be keeping an eye on. Now, the stock did sell off and it's down over 35% since in the past month, more predominantly since their earnings, and that was because they did miss on their revenue. Now, the funny thing is they didn't miss crazy amount. They didn't miss by 10-15%. They missed by 0.8 to 1%. 1%. They were guided to make around $1.94 billion of revenue, and they only came in at around 1.92, so they were shy of just 20 million. So rather than selling off the stock and, in a warranted sell-off of maybe 10-15%, Wall Street and retail looked at this stock and they said, we are going to wipe out 1.2 billion with a capital B, $1.2 billion worth of market cap because they missed their revenue by just 20 million, which I think is an overreaction and it's an overkill. And it's something that I've just looked at this point and I'm thinking, I'm a value investor, I'm an asymmetrical investor, and I like to follow smart money. And we've seen the likes with this software before. We've seen this with ServiceNow, we've seen this with Salesforce, we've recently seen this with Microsoft, where specific software stocks, they do get beaten down. And as time goes by, smart money accumulates during the correction and consolidation phase, and then the stock, it will be very well due a rebound in the following months or quarters to come. So it's come to a point where I think a position in this is viable, it's plausible, and it's warranted, and it's a position that I most certainly will be opening up. Now, just a quick disclosure, this is not going to be a very large position in my portfolio. I seek to make this below 3% of my holdings because this is what's going to be referred to as a short-term swing trade. Short-term swing trades are basically when you buy a stock and your goal is to make money over the short term. You don't want to be sitting on it for years or for decades. You want to be in and out. Sometimes it can be a few weeks, sometimes you can be out within 3 to 6 months. So I did do a video recently about Ondas, did I not, when Ondas was $7 a share, and I said this looks like a very good swing trade, and at the time of filming Ondas is $10.40, and by the time you guys see this we will have their earnings results, so the stock could be a lot higher, a lot lower, but even if you sell now, you would have still made yourself 43% profit over a course of just 4 weeks since that video came out. So this is a whole goal of a swing trade. You're buying a stock, you are holding it short term, you're not in it long term, and you're looking to make quick value because you think during this time there's catalysts going for the stock, or maybe you just think the stock is undervalued, and sooner or later investors are going to start realizing that and putting money into it. And I always say with investors, sometimes when stocks do go down straight after earnings, you sort of want to wait a week or two before throwing your money. I know a lot of investors started buying up the dip at 330 and the stock sort of went down to 303 last night, but I do think even at 330 this stock is undervalued as per my DCF of around $400 as an intrinsic value. So this is a business I like. I like the guidance. The guidance aren't too bad. Some investors are a little bit concerned about margins being compressed, but I will say this business is working on very, very big margins. Their free cash flow per share and cash from operations are quite solid. And I'd say this business has been going on full cylinders for quite a while and full throttle. And sometimes that is not sustainable when businesses are running at such a fast pace over many, many quarters. I think sometimes analysts do get ahead of themselves and they raise the bar even higher without realizing that there is going to be a time when these margins do get compressed. EPS might be sort of a little bit lower going forward than what some expectations were, and the stock does sell off. But I think at the end of the day, this is a very good value play, and if you're someone that you want to buy a good business and at a good valuation, I think Applovin is definitely worth a little bit of research. Now, as always, guys, this is no financial advice. This is just my own personal opinions. I like to try and be as transparent when opening a position, and sometimes even try to do a video like I've done in the past with pretty much all the stocks in which I hold. And time will tell if I'm right or wrong, but I've got a good feeling about this stock. I think the fundamentals, the financials, the moat, the thesis, the growth aspect, and even the proprietary data, the singularity scalars in which this business has on their customers, the ontology in which their AI systems have, I think is quite good. Obviously, we're going to see a bit of Axon, and we're going to see how that works out with the business and see if that can sort of be back to full throttle as which management was hoping, as we know that's sort of been underperforming and maybe coming a little bit shy of some investors' expectations. So there's definitely things to be keeping an eye on this business, but I'm quite happy, and I'm happy to make a small short-term position on this. And I might look at probably exiting at around $400 if anyone was wondering what my exit plan would be. As always, fellow investors, take care. Do, of course, do your own research, and hope you have a good day in the stock market.